In this video, I'm going to talk about a few basic principles associated with the estimation of cash flows for capital budgeting. So if you've been following along with the videos up to this point, and you've been thinking about payback and discounted payback and net present value and IRR and MIRR and benefit cost ratio and economic profit and all these kinds of things, ultimately, in order to calculate any of those, you have to have cash flows. You have to actually have data that gives you cash flows and information about what a capital budgeting project is going to do in order to determine what the cash flows are, which you can then use in the calculations to assess whether or not you like the project. So that means we have to come up with cash flows. So let's talk about a few basic principles associated with estimating cash flows for a capital budgeting project. First off, collecting the data and estimating the cash flows is the most important step in the capital budgeting process, which kind of brings me to a clarifying point here. So when I say that's the most important step, I'm not joking. It's the most important step. So let's kind of rewind a little bit. Calculations like net present value and IRR and MIRR, you ought to be able to get those calculations right every time. I mean, some of those you can actually straight up do with formulas in Excel if you have the cash flows, right? So basically, as long as you know how to do the actual calculation, and you do need to know what the calculation is doing before you just start using a formula in Excel, little side note there. But as long as you actually know how to do it, those are pretty much relatively straightforward calculations. Those are not the hard part. The hard part is figuring out, if I buy a piece of equipment, what does this do to the cash flows for my business? In other words, collecting the data and figuring out what is the impact of this thing on cash flows. That's actually really the hard part, because there's no perfect answer for what any given project is going to do to the cash flows unless you know the specifics of the project. So there's not like a perfect list of it's going to do exactly this. Well, I mean, I can give you categories and general classifications of the types of things to look at, but it's different from project to project. So for each project, you have to look at the situation and figure out, what is this doing to cash flows? So collecting that data and ultimately piecing it together in the appropriate manner to estimate the cash flows, that's the most important step. Because if you mess up the cash flows, all those net present values, IRR, MIRR, payback, discount payback, all that stuff basically is going to be based upon incorrect data, which means you could potentially be drawing incorrect conclusions and making bad decisions. So figuring out what the cash flows are and collecting the data that leads to that is the most important part. Now, what cash flows do we care about then? Well, the relevant cash flows are what are called the incremental cash flows. What are incremental cash flows? Incremental cash flows are the cash flows that are directly attributable to the project. So here's what that means. Basically, the incremental cash flows are the ones that if I do this project, if I buy this piece of equipment, this cash flow happens. If I do not buy this piece of equipment, the cash flow does not happen. That is what we're looking for. If it's a cash flow that's going to happen, whether I do the project or not, that's not a relevant cash flow. I don't really care about that. What I care about is, if I do the project, this cash flow happens. If I don't do the project, the cash flow does not happen. That's the cash flow I'm looking for. So we're looking at all the things for which that's the case, and we're going to put them together to figure out what the cash flow is associated with the project. And basically what we're sort of building towards here, if we kind of back up to some things you might have seen previously, free cash flow is kind of what we're getting at here. And basically, to express free cash flow, what we're getting is that net operating profit after tax plus depreciation. And I'm adding back the depreciation because that was a non-cash expense. So if that was a non-cash expense, that would have factored in the NOPAT. I'm adding it back in because it was non-cash. But then I have to subtract capital expenditures. This is any money that I spent on like buying fixed assets year by year. So I'd subtract off capital expenditures. I'd also subtract away any changes in net operating working capital. So if buying a piece of equipment triggers that I have to have more current assets on hand, well, buying more current assets to have on hand is an outflow of money. So I've now changed my net operating working capital. So when you see net operating working capital, think things pertaining to current assets and current liabilities. So if I changed my current assets or current liabilities that resulted in a net outflow, I have to account for that. So basically, we're going to be looking at kind of period by period. What effect on cash flows is this project having? Now, that does bring up an interesting little side note pertaining to what frequency of time should we use when estimating these cash flows. So you could use annual. You could assume that I'm looking at annual cash flows. And the benefit of that would be, if I had a 5-year project, then I've got 5 forecast periods plus today, right? So I've got 6 total periods, right? It's gonna be, start at buy today and then last for 5 years after that. And that's not too bad. If I did say, let's say I did a quarterly analysis for that project. Well, if I got 5 years and there are 4 periods per year, I'm gonna have 20 future periods, and then today. So now I'm up to 21 periods total. If I did monthly, well, if I got 5 years and there are 12 months per year, that's 60 periods going forward, plus whatever I spend today. So now we're up to 61 periods. So you could try to have smaller periods of time, and maybe you could even tailor that to, Christmas rushes or seasonal things in the summer, or, whatever, holidays. You can try to tailor this forecast and make it all kinds of accurate and factoring in all this stuff. But the problem is it starts getting really a whole lot less feasible to do because now my workload has gone up dramatically, right? And the reality is when we're projecting the future, it's not like I really know all that stuff with great accuracy anyway, most of the time. So from that standpoint, it's important to kind of keep in mind that, you might have that temptation to try to go into, let's make it super accurate. The reality is it's going to be based on forecasts, which are subject to error anyhow. So from that standpoint, it's debatable just how much more accuracy you're going to get by doing a whole bunch more periods. And it's probably making it a lot less feasible. So there's kind of a tension there. And not every scenario would necessarily use annual numbers. Most of my examples that I've done in the videos in this sequence so far have been pretty much annual numbers for capital budgeting. But it's not mandated, it's not required. But there is a thought there of kind of balancing that tension between sort of feasibility and accuracy. So kind of keep that in mind before you jump off the deep end with an analysis and start trying to do weekly analyses over the next 5 years or something. All right. Hopefully this video has been helpful. Thank you so much for watching and have a great day.